Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we're going to learn a concept which is known as fiscal year versus calendar year. Many of the students they really face a problem in differentiating between these two concepts. It's fine. After this explanation, you will have a real clear idea regarding what exactly is the fiscal year and what is the calendar year. Now, if you see the example over here of Colgate Palmolive Company, the Colgate reports its financial statement for the year ended of December 31. Now, this simply means that Colgate uses calendar year. So, let's say for 2015, they start at 1 2015 to 31 12 2015. So that's the difference. And this, I mean, if you look at this particular scenario, the calendar year over here is the 1st January to 31st of December. This is another example that I'm showing you is the United States Security and Exchange Commission. This is basically the reporting that has been done, the annual report pursuant to the Security Exchange Act of 1924 for the fiscal year ended June 30th. So P&G, Procter and Gamble's fiscal year, this is what they have defined. Right. So this is for the Procters and Gamble. Now we note that P&G uses a different year ending reporting its financial statement than what the Colgate have used. So you see that the P&G is using a fiscal year ending June 30th. So what does this mean exactly? Now can we compare Colgate's 2016 calendar year performance with P&G 2016's fiscal year? Now, what is the rationale for choosing a different financial reporting year than the calendar year? So in this tutorial, we'll look at the fiscal year versus calendar year in a complete detailed format. Now, a year is basically simply defined as a time taken by the Earth to make one revolution around the sun, right? What are we talking about here? Now, what is calendar year then? So, generally speaking, a calendar year is basically, you can say it begins on the New Year's Day, that's the 1st of Jan, right, of a given calendar system, and ends on the day before the following New Year. So it's you can say it's 31st of December, right? And thus consists of almost the whole, I mean, it's a whole number of days. So there are different calendar years like, Islamic one, Georgian one, and so on and so forth. But one which is most widely used is the Gregorian one calendar. I mean, it begins on the 1st of January and ends at 31st of December, consisting of 365 or 365, 360 days, depending upon the leap year, because usually it's 365, 366 in case of the leap year, which is once in every 4 years. Now, similar to the calendar year, there is something which known as the fiscal year. Now, it is a period of basically of 12 months and is used for calculating and preparing the annual or yearly financial statement, the business and other organizations all over the world. So, why is the concept of the financial or the fiscal year is needed? So, before understanding the need for the fiscal year, let us briefly understand the meaning of the financial fin statement or the financial statement. See, financial statement, it presents, all the relevant financial informations about the business in a structured format, like balance sheet, your income statement, your CFS, which is known as your cash flow statements, and forms the key financial statement for any organization. If you see for balance sheet, it is a statement of the capital that has been invested into the business, assets which belongs to the company and liabilities payable by the company at a particular point of time. But if we talk about the income statement, the profit and loss account, it is the statement which presents the income that has been earned and expended, you can say that, during incurred by the organization and resulting the profit and loss over the given period of time. The next is the cash flow statement. If you see the cash flow statement reports the cash generated, utilized through various activity. The first one is like operating, then there is the investing activity, and the last one that goes about is the financial activity and used during a given period of time. So now, as you must have noticed that all the above statements have something to do with the time. And this is why the fiscal year is very important. Fiscal year is a period of any 12 consecutive months by an organization to be its official accounting period. So all the financial statements are prepared for the 12 months. Now, why fiscal year? Let's take an example on the retailing business. Seasonality in retailing business is generally seen in December, this month, and January, right? And the holiday months where the sales are generally higher than the other months. So let's assume that the retailer KG had bumper sales on the month of December 15 and December, or let's say January 16. Right. However, it underperformed in the month of the December 16 and let's make this as 16 and this is 17. Right. So case one, if KG follows calendar year, then if the management prepares its financial statement using the calendar year, then there will be two implications. The first, the first implication is going to be that higher performing months of December 15 gets included with the 2015 year, right? 2015 ending year. Second, however, one high performing month of Jan 16, if you see, uh, and one underperforming month of December 16 is included in the 2016 result, right? So when we compare 2015 results with the 2016, we note that the comparison is not fruitful at all, as the full effect of seasonality is not at all captured. Now that's where the whole fiasco starts. If you follow in the calendar year, what you will see that you'll be reporting only December 15, but Jan 16 is also one of the seasonality year which has not been reported. So again, it's going to create some problems, which is the case in calendar, but won't be affecting in the fiscal year. Now, if the retailer follows the fiscal year, this was the example for the calendar year, right? Now, if he follows in this scenario fiscal year, then if the retailer who has a fiscal year different from the calendar year, let's say from 1st April to 31st of March, let's say he follows this. So financial year 2016, which is the 1st April to 31st of March, right? 2016. This is going into the financial year, will include the high performing month of both December 15 and Jan 16. And if you talk about the financial year 17, everything is going to remain the same, just to change in some numbers here to 2017, right? So this time when we compare the financial year 16 with 17, we can effectively contrast an excellent season with that of the poor season and thereby effectively capturing the seasonality. You see the difference, how exactly things have gone here. So the importance of the fiscal year, that fiscal year defines the period over which the financial statement needs to be prepared, and this helps in the monitoring the key financial statistics and enables the organizations to understand where they stand at the end of the fiscal year. The next thing that we need to just address a few things is some of the most commonly used fiscal years by the business all over the world are the 1st Jan to 31st December, the 1st April, sorry, the first one doesn't come, 1st April to 31st of March, and 1st July to 30th June. These are the most followed one, and 1st October to 30th September. I hope you have got a clear idea regarding fiscal year versus calendar year. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.